CFC St. Moritz, and I'm welcoming you here to the CFC St. Moritz Mountain Talks. What we want to do with the Mountain Talks is to have discussions with opinion leaders and industry experts in the fields of the TradFi, crypto sector, as well as academia and regulation political sector. And I'm looking forward to our guests. So let's start with our first discussion here with Caroline Weinberg from BNY Mellon.
CFC St. Moritz Mountain Talks.
I would like to welcome Caroline Weinberg, Chief Product and Innovation Officer at BNY Mellon. So Caroline, welcome.
Thank you so much.
Perfect. So let me just start like as a mountain kid with the most important question at the moment. What did happen yesterday with Carlo Janka on the slopes?
So he beat me in a race. He beat all of us. It was very impressive. It was wonderful to ski. It's beautiful here. And it was really fun to do a race course and be challenged to watch him go and then go after. It's very impressive.
Perfect. Good. So let's first maybe talk about you a little bit. So you led tokenization of BlackRock, you built that up, and then you changed to, so you left the world's largest asset manager for BNY. So my first question when I read that was like, why that change? Like, what was the intention behind it, if you may answer?
So I loved BlackRock. At BlackRock, I was the Chief Product Innovation Officer. And in that, I worked on a lot of the elements of tokenization and digital assets. Prior to that role, I was the global head of product for the ETF and index business. And in these roles that I had at BlackRock, I learned so much about driving scale, all the different asset classes. And as head of product and innovation or chief product innovation officer and working through all sorts of elements of digital assets, I realized that to transform markets, I really needed to be closer to where the assets were. And BlackRock plays this amazing role as a standard setter in so many elements. And at the same time, when we think about the future of markets and the transformation of always on 24/7 markets, in order to help drive that transformation, being at BNY was my hope. And I spent a lot of time with our CEO, Robin Vince at BNY, about the role BNY and his vision for what BNY is doing in transformation and the role we could play together and the roles I could play at BNY. And what's amazing and exciting about BNY is that we are the financial infrastructure today. We have 240 plus years of experience being that financial infrastructure. Yes. And while some may say like, oh, that's like the plumbing, that's not interesting. Actually, it's the most exciting and interesting because as we think about the transformation, it's got to be at the asset level. We are custodian to about just over 60 trillion in assets. We do over 2 trillion of payments every day. We're the largest collateral manager. We're the sole issue of treasuries for the US government. We clear most treasuries. It's remarkable the platform and the expertise we have. And with that depth of expertise, we're able to reimagine and rewire the financial markets in a safe, secure way with our clients and with the regulators.
But just here, as like you mentioned, 241 years, right? So I can imagine like coming from BlackRock, like kind of innovative, right? Young in the market compared to that. And now you come to a custodian, 240 years old. So what was for you kind of not the biggest difference, but like if you compare both of them, like culturally also, how do you see that? Because with 241 years, I guess people should say like, well, we know what we do. Why should we innovate and so on? So how do you see that, like that difference?
Yeah, absolutely. BlackRock is known as an innovative product culture. And BNY is not as known in that way in some fashion. At the same time, in order to have been a leader in financial infrastructure for that long, it's actually been an innovative firm. And it's just not very public about many of the things. So when we think about real-time payments or the actual ability to drive tri-party and really be that financial infrastructure, it has always been innovating. Now, the question is, how do you embrace new technologies in a regulated, scaled way? Because when we talk about the scale of institution and the scale of BNY, 60 trillion of assets in custody is a whole other ballgame for digital assets. And it's about that acceptance and understanding of how do we enable this new technology in a safe way for our clients to help them grow.
Mm-hmm.
And we can do that from where we sit because of our positioning and our expertise. And frankly, being regulated is really important. So for us, we can help drive that institutional adoption to enable our clients to grow faster and have better markets. And that's always been the perspective of BNY,
Mm-hmm.
but it's taken different forms.
Mm-hmm.
And now we're able to do that with a digital asset lens. And when I joined BNY a year ago, there already was a lot of thinking and work done in digital assets,
Yeah.
alongside many other areas, including AI. So I would say we've always been innovating on one hand, but we're not known in that way. And now we are better known in this format. And I think Robin Vince, our CEO, has been much more vocal about the transformation that we are leading on behalf of our clients. Because again, as the plumbing or financial infrastructure of the market, we need to enable that speed, efficiencies for our clients.
So just getting to that point, right? I think what is interesting here in November 2025, you wrote the white paper, right? Where you mentioned blockchain works in concert with traditional rails, right? So you're saying, so as I read it, like you're not replacing overnight, it's kind of coexisting. But if we look long term, we heard it also on stage today, is blockchain taking over like the traditional rails, or do you see like kind of that coexistence, right? Because I understand your point that, and we discussed it also before, and we had the discussion before in the green room, in the sense of, well, it needs time that that digital asset industry understands also what is needed in the traditional one. So what is your long-term view on that topic?
So we have these brilliant systems that work.
Uh-huh.
They've been assessed, they work, they drive our financial systems today. And when we think about the financial markets for the future and digital assets and what blockchain can do in enablement, there's a whole host of use cases for digital assets and for 24/7 always on programmable. But actually, there are a whole bunch of use cases and enablement of systems that exist today that will continue to be critical and important.
Yeah.
And you have a whole host of embedded processes at the whole entire financial system today.
Yeah.
So if we imagine a world where everyone has to move to a new system, it's a bit tricky and it will take time. So we don't have to say everything's going to move. It may, but in fairness, my daughter's piano teacher still only wants checks. I use Venmo. I use all sorts of mechanisms to make payments. We obviously have stablecoin as well, but there are still people who only accept checks.
Yeah.
In that, we're going to have a lot of clients who have systems that they use that are really very much compatible to more traditional systems. And that's great. And we celebrate that. And we're going to use what we know from old systems or traditional systems and continue to grow those as well and improve those, as well as this element of digital. And what's important about blockchain is that you can actually have the blockchain ping into old systems or traditional systems, and we can extract what we need from it as well. So it doesn't have to be an either or. Actually, the concert is at least the near term and medium term answer for the driving of institutional adoption.
So, but do you believe that there is like in some years from here now, like long term, that it's like, let's assume you have like those different criteria that you need from for traditional finance processes. You see a future of like, okay, we have now everything on blockchain because it's probably more secure, faster. Do you see a future like that, or do you think that we have always systems that need kind of that traditional approach?
So I think there's definitely a possible future state, very long term, that is all digital. At the same time, it's sort of not that relevant because in the near term, you really do need the two systems to work. If you want cash to move 24/7, the Fed needs to be opened in a different way as well. So if you start to think about all the dependencies we have in the network and the systems of cash, which require so much trust in our banking system, you need both systems.
Yeah.
So unless every system really evolves and transforms, then we're in a world where there's this bridge between the two. So I think it's definitely a possible future world, but we don't have to get there. It actually is okay to have two systems that very much work in concert together.
Okay, so if we look at the situation at the moment, what is the missing piece at the moment for you? What is missing to really like have that the next step happening?
I think that one of the most important things when we say tokenization, what we're really saying is what are the books and records? How do you represent this particular asset on a blockchain? And the progression of private permission blockchain. So first assets onto that,
Mm-hmm.
and then secondly, potentially assets into more public chains with permission and so forth. So the ability to start to track, to understand the transactions, to be able to monitor and manage in an auditable way from a regulatory perspective. Stage one is very much the permissioned. Stage two, then can we extend that to broaden the market further? And we may or may not get to stage two for all things, and we may not have to get to stage two for all things.
Good point.
But it needs to interoperate. And I think stablecoin is a great example of interoperable, because for us at BNY, we have deposits. They're the balance sheet of BNY. At the same time, if someone wants to turn a deposit into a stablecoin, we can help enable that, working in partnership with stablecoin issuers. And that goes outside the system. So there's such a nice way to think through the interoperability between private, public, cash movements inside, cash movements outside. It doesn't have to be one or the other. It's about that interoperability and the way to connect existing financial markets, existing systems with that future state as well.
So you mentioned stablecoins, and I just want to come back to that, because I mean, stablecoins are for me now like the first use case for crypto, probably. And then going back to what we said, if you look at that long term, it's kind of like going in that, like, okay, we have a blockchain, we have something on that blockchain going back and forth that you can use. So if we look like as at BNY, since the Genius Act, you're leaning heavily into stablecoins, right? So you are with USDC, you have other stablecoins also under custody. So you have like the Dreyfus Stablecoin Reserve Fund and so on. So what is the strategy there for BNY? Are you planning to be kind of the backbone of that new stablecoin ecosystem, or what is it?
So absolutely, that stablecoin has emerged as this amazing tool for cash. And when you start to think through, like, what is a stablecoin, in a very simplistic way, it's cash and treasuries sitting inside of a vehicle that can be used as payment. And if I take $1 in my pocket, tomorrow I don't have interest on that dollar. I still have $1. And in a year from now, I still would have the dollar. So a stable coin, while some say, okay, it's interest bearing or not interest bearing, it's just like the dollar represented, but backed by cash and treasuries. So there's a very simplistic, sort of beautiful nature to what is a stable coin. And what do we do at BNY? We do cash management, we do reserves of treasuries and custody of this. So we are the reserve, either manager and custodian or whatever it might be. We play different reserve elements for stablecoin. We also do a lot of the payment workflow on behind issuance or the minting and burning, and all sorts of other elements of the workflow of cash flows that take place in a stablecoin. And we are very much supportive of that system. And our view is, by being the reserve manager for, or reserve custodian for these different stablecoins, including RLUSD and others, we can then enable that interoperability between our role as a treasury provider, like we do, again, issuance, clearing, custody of treasuries for all these players, but then the whole market and the deposits that we have. And then again, what is stablecoin is cash and treasury. So again, this ability to turn one into the other, decompose cash and treasuries into, compose it into a stablecoin and back again, is that interoperability in the future. So we play that role. And the question is, like, what is the strategy for BNY?
Correct.
So when I think about BNY, we are very much in the storage business. On one hand, we are safekeeping the assets of the financial markets for our clients. And as I said, it's about 60 trillion today, but we do so much more than that. But essentially, in very simplistic ways, we are safekeeping storage. And tokenization enables this amazing capability of mobilization. And what is the first layer of mobilization? You need a cash leg. You need to pay for something. So our perspective, and where we've been leaning in from that perspective, is around this concept of different elements of what make up digital cash. So there's deposits, there's treasuries, there are money market funds, and stablecoin. And in fairness, a money market fund is treasuries with a little bit of cash. A stablecoin is money market, treasuries, and cash, or some combination of. And then you have these decomposed pieces that can go into each other.
Yeah.
So our strategy has been about how do we help enable our clients to mobilize and make dance their assets to unlock value? And how do we enable the movement of this through tokenization and through this cash layer? So our strategy is around storage and mobility. But there are two critical things we need for that from an infrastructure perspective. One, we need the blockchain to be fit for purpose. So we need, again, this concept of a private, permissioned, and very capable blockchain, or combination of blockchains. We need to be interoperable with different blockchains, internal and outside, right? And then we need a data layer. So we think very much, we spend a lot of time on digital market infrastructure, which again is like the blockchain and all things we need related to it, and the data layer. Because if you're enabling transactions on behalf of our clients, what's the price? Where are the holdings? All of the pieces that we do today, we need to make sure we maintain, again, on behalf of our clients in the regulated way for them. So it's about custody or storage, mobility around cash and tokenization, digital market infrastructure, and data.
So I mean, based on that, what you just said, like, do stablecoins help you now? Like the whole, what do you say, topic of stablecoin help you now to talk to kind of traditional customers more, to say like, hey, look, that's now what we can explain to you. They can relate to it, like, rather than, I don't know, Bitcoin or Ethereum or so, if they're really not savvy. So is that something that helps you in the discussion?
So it's interesting. Digital assets is a very broad space. So often it's about when we talk about digital assets, what do we actually mean?
Yeah.
And there are different pieces to it, to your point. Sometimes immediately people go to cryptocurrency. They go to Bitcoin, Ethereum, and they want to talk about that. And then in the same sentence, they may talk about a stable coin. So when we try to decompose, we say, okay, there's the ledger, the blockchain itself, which is the base of all things digital.
Correct.
You have currencies that come from that in many ways. And then you have tokenization. And stablecoin is one of those pieces of tokenization. And starting to separate it out into what we're talking about is really important. So often people say like, oh, tokenization, that sounds really fancy. And in many ways, it is a little bit like the jazz hands around, like, we're just representing something on a blockchain.
Yes.
And when it's really cool when we're at BNY. So as we talked about, we're 241 years old, and we have a lot of amazing historical records at the firm. So we have the original ledger from the firm. So on my floor, you can see Alexander Hamilton's writing of who holds what in big pieces of paper. And actually, originally it was in pence before it was even dollars. We have all of this. And now when we think about what is the blockchain, it's actually today's version of what Alexander Hamilton was doing in ledger.
Yes.
And that's why when we think of BNY, like, we had the original ledgers, we've evolved it to computers, and now we have a distributed ledger system. So, and we have, we have all sorts of systems to maintain our books and records as appropriate. But that concept of like it's evolving and moving is sort of what's important here. So when our clients are coming to us and saying, we'd like a stable coin, or they want to understand what is Bitcoin, we sort of separate it out into what are the different pieces and start to think through, well, how is this useful to you? Because ultimately it's about use cases.
Absolutely.
And it's use cases at scale.
Yes.
And sometimes clients don't even want to know that there's a blockchain. They just want something done faster. So if you're sitting in Asia and you want to settle a treasury faster, it may be the case that someone would want to use some type of blockchain to enable that type of settlement. But in some cases, actually, a traditional system would work just as well. It's just that your middle office has to be open a little later.
Yes.
So stablecoin is a really simple way of explaining like the movement of money and why there's no interest on it, because similar to the dollar in your pocket. At the same time, the whole blockchain enables the conversation of all things and what could be evolved and what is a good use case and what's not actually that interesting. And in many cases, I think earlier days, people were saying, oh, you could tokenize like anything. And people were imagining almost like crazy things to tokenize.
Yes.
And it became almost too theoretical
Uh-huh.
and not realistic.
Yeah.
So when you go back to the basics of how do we serve clients today
Yeah.
and what are their biggest needs, is this going to help them or not? And stablecoin is just payments in general. As I said, we do over 2 trillion of payments a day. Can stablecoin be in that menu of opportunity for you for making payments and managing your cash? And the answer is like most likely yes. But does that mean that FedWire goes away, or real-time payments is a great alternative that's instantaneous also? So there's a lot of elements of that. But yeah, the conversation around stablecoin and the adoption of stablecoin and the growth of it, and in fairness, that there's now public companies that are like Circle, that is a stablecoin company, has mainstreamed this concept of digital cash in a way that is a nice conversation.
Yeah. So, I mean, again, coming back to what you said, like that, like the whole company and also CEO is like more vocal about digital assets and that it's like more prominent. So in the end, as I understand, right, the business is always about numbers. So if you compare it to like other business lines and income and so on, so where do you see that like priority then for the company, right? Because at the moment you have probably other business lines that contribute more to the financial results. So long term, or again, like it's again a, how to say, innovative move to like look at that, put also like how to say, some investments in there. So how is that compared to the other business lines? If you can comment on that.
So when you look at BNY, we are the largest in so many interesting and important businesses, again, as infrastructure for the financial markets. And every one of our businesses, we're looking at how can digital assets and how can AI contribute and enable these businesses. So it's not actually like one or the other. It's actually more about how do we leverage all of the products that we have to enable a new system? How do we look at all of what we have and say, gosh, given our depth of knowledge, our deep expertise for 240 years in financial plumbing, financial infrastructure, how do we leverage that expertise, the client relationships, and that scale that we have to actually help our clients create efficiencies and enable them to grow faster? So it's actually an evaluation of all of our businesses and growing the entire firm. It's not about this P&L or that P&L. It's, if you think one P&L for the firm, the whole business is growing as our clients are growing as well.
But just to your point, I mean, we talked a little bit about culture at the beginning, right? I mean, let's assume I'm sitting there now since 30 years, right? I'm doing my traditional work and so on. And now it's like, hey, digital assets is here. Like, we have to think about that and so on. I mean, isn't there like a lot of pushback internally also at the beginning about certain things, right? So how do you handle that, or how do you convince those people that that's something that they should think about it? Is it a cultural thing? Is it, what do you think?
So what's really cool and exciting, and you probably saw in our paper that we published in November, where most of my executive committee was quoted. So in fairness, while I may have been the lead writing some of the thoughts, I wasn't the only writer. And what was really fabulous was that most of my executive members wanted to participate, be quoted, and had real thoughts on it. For me, I'm lucky in that the firm started a journey of AI first. And the concept of how do we embed AI everywhere for everyone is actually the first version of, hey, what am I doing today? Can I do it better? Can I evaluate the businesses for my clients in a way that I can improve my products? I can improve the efficiency. I can maybe save time. Some of our clients, maybe there's a payment error that we need to solve or some resolution. Can we use AI to do that faster, better, everything for our client? So if you obsess about what your client needs and you start to say, I'm going to see, how do I embed AI into that? Then the next evolution is actually this technology that programmable. Actually, AI is.
We can start at the end with Ray again. If you all want to introduce yourself, give your name, company you work for, and anything else you want to add.
Hi, everyone. I'm Ray. I lead products and research at Grayscale. We are the world's largest crypto-focused asset manager. I've been there since 2018, and I was lucky enough to get to build the company from when it was 5 human beings to what we are today.
Hi, everyone. I'm Jenna Pilgrim. I'm the head of portfolio growth at CoinFund. I joined CoinFund about 3 years ago to reimagine how VCs help post-investment and make sure that we are actually sort of walking the walk of and talking the talk of what how companies need to be built once they have VC investment, because we take a big portion of ownership in a company, and I think we need to give them back something for that. So I joined CoinFund 3 years ago. Before that, I was a founder myself, a VC-backed founder, worked on a startup for 4 years on intellectual property for digital assets, and I got into the space in 2014.
Hi guys, my name is Gary. I am with Further Ventures. We are an Abu Dhabi-based VC. We both incubate and lead up to Series A of companies primarily doing institutional middleware. So everything from custodian infrastructure, broker-dealer infrastructure, both on the regulated service provision side, as well as the actual technology that underpins it.
Yeah, hey, I'm Alvin Sheth. I'm a partner at Borderless Capital. We focus on crypto and blockchain. We invest in equity and in token companies. We've been around since about 2018. Prior to Borderless, I was working on the Libra project. And prior to that was in academia. Yeah, the focus for Borderless is infrastructure in the crypto context, but essentially we're looking at the ones that actually have the ability to scale in a borderless way geographically, and also that can expand to the mainstream. And that's been the focus for about the way that the team sees founders and
sustainably when crypto narratives are constantly rotating. So for the first question, maybe let's talk about like what is a narrative and what's driving the narratives. Is it the KOLs? Is it the VCs? Is it just the price? Or is it something else? Go for it, Jenna.
So I think differently from other cycles, we're really seeing revenue and fees drive narrative. And I think that's a lot healthier. It means that those of us who come from traditional finance understand that things can actually be measured. We have some models that we can run on protocols now. And we never used to be able to explain why protocols were able to grow or why developers wanted to build on them. Many people hold the belief that the best technology will win. And I think we've actually seen that to be not true. The best technology won't win. The best distribution will win. And I think that distribution is really incentivized by what revenue and what protocol fees you can pass on to the user. This whole concept of collective ownership, but also collective earning, is a new concept. It seems kind of like silly and novel, but yeah, that's a real narrative driving forward, I think.
I'm with you. If I don't have to review another pitch deck for a governance token for an RWA protocol, I'll be the happiest person on the planet. But generally seeing whether it's protocol revenue getting shared out to the users, or there being actual meaningful value that it can drive, that has to work. It has to be a real business at the end of the day, which, this is great bear market vibes. We actually have to go and make money, which is my favorite actually time to be investing.
Yeah, I think this is a fundamental question. I think it comes from a lot of different directions. So one direction is definitely VCs and investors. They set a longer time horizon for their investment theses and the things that they're looking for. They fundraise based on that, and they look for founders building in those areas. So I think that they do have a pretty critical role. I think the other factor is builders and founders. They can spend years and years. Eventually, once they find an opportunity window, they essentially create a new market or a new space for themselves and for others that come in and compete with them. And that, I think, is the strongest signal for people to be like, okay, this is something to look at, whether it's prediction markets, etc. And at the same time, yes, there's a lot of noise. I think about academia a lot. You have a kind of similar problem where people come to fields looking for something to discover, and you can be caught up in like a shiny object kind of syndrome, right? Where you're just like, okay, what is the thing that people are talking about at the moment versus what is the thing that's really valuable. And in academia, of course, you could take like 30, 40 years to address something versus in, in the world of technology and startups, you don't have a shorter time horizon. But, I think we're getting signal from very few places, but I think that right now, what people talked about with revenue is something that, I'm sure we'll talk about it further on, but I think that that's maybe the second factor I would consider.
I agree. We look at revenue. We look at a lot of metrics, the way traditional investors in finance look at them. I think it's still early. I think in crypto you have pricing has been driven by sentiment and narrative, and product market fit has really lagged. So I think retail still plays a huge role. I think it's okay. I think that's in line with the sort of egalitarian ethos of crypto and how it all got started. It's easy sometimes to dismiss some of these things because it's zeitgeisty. But I think the retail component will always be an important factor.
So it seems like everybody thinks that revenue is a narrative right now, but how much of that is just that we're in a bear market and prices are down, so people need a reason to justify like holding coins in a bear market? Because there's that meme of the intelligent investor being thrown into the trash can that everybody sees on X when prices are going up. And right now prices are down, so people are pulling it out of the trash can. But how do we know that like that's not just going to happen again? And are we just following this endless loop that we're in? And we're really just following price rather than actual revenue.
I think we don't know. I think that's one of the things we as an industry continue to try to figure out. Right now when you think about like historically the fat protocol thesis, you think about revenue to L1s, that being the value accrual layer. But over the long term, we don't really know, right? It could not play out that way, right? The infrastructure level layer could become commoditized. So it'll be interesting to see how it plays out in terms of value accrual.
Does anybody on the panel think that L1s actually make money? Can we see a show of hands of people who think that like L1s should be valued based off their revenue or something else?
Like today or
long-term revenue prospects?
Yeah.
Okay, long-term revenue prospects. Okay, interesting.
Yeah, I think, there's this concept of trade-off between growth and revenue at the early stages. And I don't think it always makes sense to apply that. So the thesis is that at the early stages, you focus on growth and you don't really emphasize as much on revenue because you want to grow engagement or users, or it might be enterprise contracts, things that over time you can monetize. The problem is that if you build something that is going to be commoditized, then whatever you've built up, you can lose because someone else will just take that with slightly different, feature sets. I think that's kind of what we're seeing with a lot of, for example, not to harp on any one part of the ecosystem, but L2s. If you see so many different L2s, they may all have some advantages, disadvantages, or specificities, but there's so much commoditization that after a bunch of retail has gone and farmed and done whatever it is they wanted to do to use that infrastructure, they moved on because there isn't really enough differentiation. They don't need to be there. And I think that the growth versus the revenue concept makes sense when over time you can actually monetize it and have that stickiness actually hold. So I think we have to be clearer about, as investors, where is there a benefit of making that trade-off in the right direction versus where it might not pay off?
I think many investors really sort of overestimated the multiple that like revenue or growth as a multiple of revenue. I think we significantly overestimated that, and I think we need to give protocols a little bit more room to grow and assign it's not a 10x revenue multiple. It's probably like 100x. It's like probably way more. And so I think that we need to be a little bit more fair to protocols that are trying to disrupt 100-year-old systems. If we're trying to disrupt 100-year-old systems, yeah, we've been like commercially in crypto for like 10 years or so, if you're being generous. So that's not near enough time, especially if a protocol has come out in the last little while. But I think something that people do get wrong is that like if a protocol had its sort of day in the sun and then it came down again, there's probably no dragging it out of here. Very little possibility of it being dragged out here. And like so much time and money is invested on trying to like drag the protocol back out of the mud. And like, I think crypto in general suffers from a very deep sunk cost fallacy. And I think we need to be pretty honest about that.
Well, isn't that just another argument for like price driving everything? Because if your success is based on the token going up in price, then that's not the right multiple. And that's why we've seen a proliferation of stablecoins amongst all kinds of different protocols and people paying fees and paying revenue or like accruing revenue in stablecoins because they don't have to then rely on, okay, well, cool, we might be earning this much in tokens, but the tokens are going to go up and then that's going to be great. But like, that's not the case at all.
And we're really the only industry in the world that, because of the way that a lot of protocols were fundraising in the first place, they're protected from the kind of governance that typical venture firms would take in straightening a business out. You know, if you raise hundreds of millions of dollars and you haven't shipped anything for a decade, you probably need to be fired. But that's just something that we kind of have to live with, you know, as an industry.
Yeah, I mean, I think there's something interesting with how VC investment happens in this space, right? So as many are probably aware, when we make investments, we invest in equity and token in a lot of projects. And what's interesting is that even in projects that we expect to launch tokens, we still like hold on to this equity. And I think there's something to really kind of investigate here, because the quality, it's not just about them being quote unquote assets, these tokens. It's like these tokens may or may not be of the same quality. And a lot of the things that you get from owning equity, a lot of the governance, a lot of the institutions that are around some of these types of investments don't exist for tokens. Obviously, what we do see and what we, I think, give a lot of value to, maybe overwhelmingly, is the technical capabilities of tokens, what you can do with them, how they're composable, how they can be used in different ways. But you are trading off certain things that you don't get from the tokens. And I think we have to reevaluate what the real value of those tokens actually are as an asset when you invest in it. And what we're seeing in the market, for instance, yeah, it may be where we are in the cycle, there may be a dimension to that, but you have to fight really hard to essentially prove that there's value in that token, right? And especially in a bear market, right? But I mean, I would say going forward, it's going to continue to impact and kind of haunt how people issue these assets, quote unquote assets, because they don't have all the capability and rights and features that, you know, equity has traditionally, right?
So I want to go back to something that I think Jenna and Alpin had both talked about. There's something's weird going on with the mic. So there's this idea in crypto that we often use, which is, oh, well, we're just going to give tokens, we're going to give points, and that's going to cause growth of the protocol. And I want to start with Ray over at the end. How do you look at companies or protocols and determine like who's growing organically or who's growing just because people are farming the points? And how do you think about like sustainable growth and how to tease that out? Because in crypto, a lot of times it's really hard to tell.
Yeah, it is hard to tell. I think, again, that's the point, is you want to look for revenue, for activity that is not incentive-based or emissions-driven. And I think that when you can see, if you can actually see on chain that something is being used, or for instance, you know, it's pretty obvious where there's certain projects that just spend a ton, like most of their time going out and doing business development deals and basically buying up TVL. I think that's what you're looking for, is that you're looking for on-chain metrics, you're looking for real adoption, you know, growth in those kinds of metrics that is not being bought. That said, again, I think we're early. I think product market fit has lagged price sentiment and narrative. So unfortunately, a lot of times it's easier said than done.
Okay, so Ray thinks all the crypto growth is fake. How about the rest of the panelists?
I think the growth that is volume-based is not necessarily fake. But that said, you know, if we're entering a world where it's not just human beings using all of these different protocols. If you can have your AI agent out farming points for you all day, I think we need to look really hard at like what the earning potential is from each of these different protocols. And if you're earning something by doing something, like one of our portfolio companies, Jensen, has a test net, and you can earn points on the test net by spinning up an instance of Jensen and like participating on their network and validating transactions. And actually, you have to like go do something. And I think those that are like action based are definitely useful. But net, like I'm very happy that we're exiting like airdrop season, because I think airdrops were genuinely and are genuinely bribery. And so if you're bribing your users, of course they're going to do that. And we saw that in like the growth of Ton. So like Ton had so much potential, had lots of like farming points. Like the idea of that 1 billion people are using Telegram, they had an awesome opportunity. I think they still do, right? Like they still have 1 billion people using Telegram, right? Like every single time you meet somebody, you say, here's my Telegram. Okay, well, if you can have a wallet that is 2 clicks away from the home screen on Telegram, and you can reward users for like doing stuff in there, or like sending gifts to each other, like sending money to each other on Telegram or whatever, that's great. But if you're allowing people like money from, or points or money or tokens or whatever from just like cookie clickering, like no, because that's an easily programmable thing for you to tell your agent to do.
Well, do you think that like in general, any kind of action-based thing that doesn't cost money, like the value of that goes to zero as AI agents proliferate, right?
Yes, totally.
In many ways, I have a much easier job than you do, because we don't look at anything that really touches retail. And so, I am probably of the agreement that yes, anything that has airdrops and incentives built in, please make it go away at some point in time. Though I'm with you that I think retail will persist definitely forever in this space. I mean, if you're launching a project now and you're kind of in the hundreds of millions of dollars FDV, you have to look out for retail activity, or you're going to have a really bad time. That's why you have the entire meta of listing on perp dexes and Korean dexes, and then getting the spot listing, and that entire process is just there to manage retail sentiment. And I give you guys a lot of credit for having to actually deal with that on behalf of the entrepreneurs that are launching functional projects. Our business model is slightly different. We're completely kind of government and institutional, backed. And so all of the companies that we back tend to be in that same vein. And so, when the market goes down, what was it like in October? Slept like a baby. I'm like, oh, great. Volumes went up on a bunch of our companies. Sounds like we're going to make more revenue this month. But is a position that puts you in a weird place during bull markets, because you're going to be always have a capped upside in terms of what you can do. And it's a business model choice of the GPs of the fund to either pursue that upside or to sleep at night with our government backers.
I'm so happy that you're still sleeping at night. That makes one of us. Alvin?
Yeah, so I think another word like that comes up is durability. So you have a lot of what we're seeing as being kind of episodic or periodic kind of phases of activity / value, and even when it comes to price action and or engagement, etc. And ultimately, it has to work in your favor, as a protocol or or as an investor in one of these projects and protocols. But otherwise, what it can do is it can actually erode value, right? So you're basically emitting a lot of the resources of a protocol for something that is not going to last very long, right? And then you end up in a period where you eroded so much value, and it's not just the tokens; it's also the resources and the team energy and their own whatever's being expended for the team to spend on something that is just not really accruing longer term value, right? So I think when everybody's doing it, it's hard to be the protocol or the project that's not as proactive and aggressive about some of these things. But if you pan out and you have a longer term vision and the founder is clearly committed to what they're building, then they have to play it out like 3, 4, 5 years out and be like, well, is this in the right direction of what I need to be doing, right? We see projects that are clearly doing that, for example, in the hyperliquid side, and then you have a lot of projects that maybe, have made the wrong trade-offs. So I think that, of course, retail is critical, and it's a core part of the technology stack, but the protocols have a responsibility for the longer term, I believe.
All right, we only have a few minutes left. Going to try and keep this on schedule. So I want narrative predictions from everybody on the panel. And you can't say revenue. You have to say something else. So what do you think is going to be like the hot narrative or one of the hot narratives at the end of 2026? We can start over at the other end.
I think it's stuff we're already seeing. I think you're going to see tokenization and RWAs, privacy. I think that we're at the end of 2026, we're still going to be talking about those two things.
I think every project will either be consumer and retail focused, or it will be heavily institutional, right? We'll get this year.
Well, that's
we'll
not
get
an answer.
Okay. So those are the two narratives that I think are going
Yeah,
forward.
no, I'm teasing.
Okay,
I get it. Yeah.
Mercenary, anything that's like mercenary based yield. So products that like we invested early in a company called Veda, and Veda we think is leading the vaults narrative. We think that all institutions will use stable coins and they will earn yield on them. And then that poses to disrupt a significant part of the banking system in the next 12 months. And then the other one is speculation, gambling, and prediction markets. I think we are seeing the tokenization of everything, and someone is going to build the trade everything app. It's going to be Robinhood or Coinbase or somebody we haven't even heard of. And they're going to explode in growth, and Gen Z are just going to keep betting.
So what's like that middle area that you think is kind of going to get left behind? That's like in between.
Alt L1s.
Alt L1s. Interesting. Okay.
Would love to, especially post the crash in October, cross-venue price discovery and oracles getting a little bit of love, finally, so that we can actually get normalized pricing. I think that's necessary for RWAs to work across venues. Otherwise, we're going to not be able to ship these products. So I think that's going to be core. I am with you. It is remarkably boring payments for institutions, or pure YOLO. I think anything that pretends to be in the middle, like no one buys that anymore. We're past that.
This actually brings me back to my first ETH Denver. I think that one of the interesting things that we could talk about with narratives was the metaverse, and how interesting that was as a concept for people to say that property would be in the metaverse and everything would be
even
valuable.
Zuck got psyoped by that narrative. So.
So I won't say metaverse. I think stable coins and basically things like on-chain FX are going to be extremely important. I think it was kind of covered already. So I think the other side is decentralized AI. I think that it peaked a little too early in this previous cycle, where people put a lot of emphasis on what it could do and how quickly it could perform. And even the idea that you could launch tokens and somehow get that to reflect the value of these technologies that are I think will take a long time to play out. But I believe that AI is a massively transformative technology event happening right now. There are range of narrative-driven things, hype-driven things, but I think what's happening with AI in terms of how it's transforming systems is very consequential. And I think the decentralized component of whether it's blockchains or other types of verifiability or other types of primitives will be important. It's just that it will take time for those to play out, and teams really have to be very disciplined about implementing and focusing on that. But I believe that's going to be important.
Amazing. Thank you, everybody, for your time and incredible insight.